I got a very important question recently where a viewer actually asked, essentially what he asked was, why does debt matter with value investing? And so that's what I want to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. And this is actually the Q&A series. And so what I want to cover in this particular video is, of course, what does debt mean to value investors and why do we spend so much time considering it? And so I want to start this by pointing out the question that prompted this video. And so one of our viewers, Max, who's also the new 007 James Bond, said, I don't understand one thing. Why is everybody talking about debt of HPQ, which is Hewlett Packard, when they could pay it off with 1 year of free cash flow only? And so irrespective of whether they can pay it off with 1 year of cash flow or 10 years of cash flow or whatever it is, what Max is really asking for is that why does debt matter with value investing? So let's first actually go in to see exactly how much debt HPQ has, and then I'll go into answering this question. So guys, first I just want to say, recall that as of the recording of this video, HP is on the tracker, so you can actually go into the valuation model for HP, or at least the way that I value it. And just full disclosure, this is, I think, a name that I have in my portfolio. Yeah, this is a name that I do have in my portfolio as of the recording of this video. And so the first thing I wanted to do was see exactly how much debt that they have. So notice here's a metric, free cash flow as a percentage of debt. Notice that they have just around $11 billion of debt, and so it represents or free cash flow represents around 33% of this. So it looks like their free cash flow pays this off in 3 years. Now I might be mistaken about this, but that seems to be what this is suggesting. So it's not 1 year of free cash flow, it's around 3 years, and that's fine. But now let's go into the real question. So essentially, when it comes to valuation, you're essentially adding up the total number of dollars that the company will pay you over its lifetime, less anything that reduces the value of that payment. Now the first thing that I want to show you is, you guys are very familiar with this. So like, this is the forecasted EPS that I have for HPQ. Notice that the first thing that we do is, like with this 319, is we're going to discount it when we value the company. So that 319 quickly turns to 290. And then the same thing happens to every other forecasted dollar. So for example, in 2027, the expected 425 gets discounted to 333. And so the first thing that we do, and it's one of the most well understood things with valuation, is that when we value a company, we discount their earnings because we know that the purchasing power of future dollars will be less than it is today, essentially because of inflation. So here's the thing, and I want to tie in the debt to this, is that the first thing that we're doing when we are totaling up the cash flows is we're present valuing the cash flows, because it's not going to be as valuable to us in the future. Well, another thing that we're going to do is, when we present value those cash flows, because these cash flows are going to be less and less valuable over time. If you were to just build a model and forecast out the cash flows for HPQ into the next 100 years, what ends up happening is you end up having like a graph like this in terms of like the value of those cash flows. And so, as time goes on, those cash flows they're still there in nominal dollar amounts. They're higher and higher every year, but in real value and discounted value, it's lower. It becomes a more and more minuscule value. And so effectively what you end up doing is, because the graph kind of goes like that, the first, like, I don't know, maybe like 20 or 30 years is essentially the total amount, or represents around like 99% of the total generated cash flows that you'll get from that business in real dollars. And so really you have a finite amount of cash that you can generate from the business. Now, these businesses are going concerns, they'll operate forever, but you have a finite amount of like real present value type cash. And so from that, what you do is you subtract out all the other stuff that the company would have to pay over that life period. And one of those items is debt, right? Because eventually the company has to pay off all its debt. Now, some companies do operate with debt into perpetuity, but it's up to you to decide how much debt you want to subtract with it. So the first thing that arises when it comes to valuing a company is you have to determine how much debt the company has, and then how much of that debt you want to subtract from that perpetual value of income stream, or present value of income stream. And so it actually, what debt really does for value investing is it brings down the value of the future cash flow. So that's the real answer there. And so just to illustrate that, this is what I mean. So in every single one of my models, if you go down to the bottom left of each one of those models, you'll see this excess capital calculation. And so essentially what this does is, if the company has way more cash than it has debt, you'll see a positive excess capital per share number. And really what that's saying is that if you were to buy the company today, you can extract out a certain amount of cash per share and it won't impact the operations because the company just has cash sitting on the balance sheet. Alibaba and Meta are two examples right now, as of the recording of this video, that have a ton of excess capital on their balance sheet. And so you could extract a lot of that cash, hence why you see Alibaba and Meta buy back a ton of shares, because they're trying to get rid of that cash really and return it to the shareholders. Well, HP, notice that they got $3 billion of cash sitting on the balance sheet, but they got close to $11 billion of debt. And so on a net basis, this is just a quick and dirty way of doing this. You can get way more specific. You can say, a portion of this cash is operating, and so it's not excess, and you could say that a portion of this long-term debt will stay forever. And so you can get to a different type of excess capital calculation than I am. So I just did it very simple, and so I get to a negative excess capital, $7.58 per share. So obviously, based on what I said previously in this video, what you would do is you would subtract this $7.58 from the net present value of the future cash flows. And so I just put it here, debt ultimately needs to be paid down, and so it takes away from the future discounted cash flows that you will generate. But the question is, should you discount the debt? And, I'm not discounting this debt right now, but I do believe that you should discount the debt. But to be a bit more conservative, I don't, unless it's a special circumstance. Now, depending on the circumstance, I will, because when you guys saw me build out that model for Cardinal Health, I actually did discount those liabilities. And the reason why I discounted those liabilities is because, one, I don't think that they're going to be paid completely because they're like legal type of liabilities. And two, they told us it was going to be paid over 18 years. And so I just discounted it over 18 years. And so, depending on the particular situation, you could. The other thing that you can do, and I'll talk about it a little bit later in this video, is that if they give you maturity values for the debt, you can also discount for those maturity values because you're paying back debt principal with future dollars. So the debt principal is worth less because those future dollars are worth less as well. But debt is paid back on a nominal basis, not on a present value basis, at least the principal. And so moving on to the EPS valuation, so you can see that when we value a company, we sum up the discounted cash flows. That is, of course, the dollars that we expect to come to us over the life of the company. And this predominantly captures a significant amount, like you're talking like 99% of it. And then, with the excess cash, you see that $7.58. So you can see that the valuation is around $39, 38.63 per share once you subtract for this cash. Now, remember, guys, you can do this in different ways. You don't have to get to that same number that I get to. And I'm going to show you another way that you can do this in this video. And so, once again, one of the items that subtracts from the discounted cash flows is, of course, the debt. This has to be repaid over the life of the company, and so it just needs to be adjusted for. And so I will adjust for it. And I like to be conservative, so I'll penalize the company for the undiscounted amount of the debt, but you can decide how you want to do that. Now, here's something interesting. So HPQ tells us that a portion of their debt will not be paid down, which is about 1.5 to 2 times free cash flow, which means that when you calculate excess capital, in order to do it correctly, you should only remove what is the excess amount of what they're expected to pay off. And so, I actually just did this quickly to show you the difference. So here is the excess cash calculation when you make that adjustment, because obviously they're not going to pay off all of that debt. And so you can essentially just roll the rest into perpetuity because they're never going to pay it off. And then really what that does is it reduces your excess cash subtraction amount. So instead of $38 per share, because this was $7, now you're valuing the company at $46 per share. So a much higher valuation. And so I just write it here. When you make that adjustment, you see that their valuation jumps from around 39 to 46, which was primarily driven by the reduction in the negative excess cash, i.e. reduction of the debt that will inevitably be paid down. So it's up to you how you want to do this. I just tend to be more conservative, because if I were to buy the company tomorrow, the first thing that I would want to do is run the company debt free. That's just a personal way that I like to run companies. I don't mind companies having a lower return on equity so long as they have no debt, because I'm trying to take the risk out of these businesses. And so that's the way I think about them, and it's how I value them. And so here's a quick tip. If you want to get even more specific, you can actually discount the debt based on its maturity date. After all, the principals are being paid with future dollars, so you can do that. And I have done that in certain situations. I told you guys that the Cardinal Health situation was one of them. I think also H&R Block is another one where I did that. Ultimately though, I recommend to you guys to do what you're most comfortable with. Depending on the situation, like I said previously, I utilize all of these methods. So that is essentially how you deal with debt, and why debt matters, and how it matters, and how it impacts valuations from the perspective of a value investor. And so I hope that really helped. Now, here's the thing. I believe that this Q&A series is the most important series on this channel, more important than any of the equity valuations or anything that I do, because I'm really teaching you guys how to look at these types of concepts. And so if you've missed any of the Q&A series videos, no problem. I've actually organized them all into a playlist for you guys, and you can actually get access to that playlist right here.